This
And then,
conference will now be recorded.
and then the other one is, that's Pearson.
No, I think that's McGraw Hill. You don't actually need it.
Oh,
It's not that
oh, you
expensive.
don't want us to get it?
You don't have to get it. You can make it without it.
Okay, as long as you have the one you provided.
Correct. And I think it's in the bookstore.
Okay. Okay, thank you.
You're welcome. So you should have learned about the accounting equation in Principles 1, asset equals liabilities plus stockholders' equity, which equals common stock plus retained earnings, which equals revenues minus expenses minus dividends. You should be familiar with this equation. You also should realize that we have a double entry accounting system. There's always two parties involved in a transaction, and you always receive something and give up something. What you receive is a debit, what you give up is a credit. Debit's on the left side of the T account, credit's on the right side of the T account. So this is our double entry accounting system. When we look at our accounts, assets are typically going to have debit balances, liabilities, credits, common stock credit. Retained earnings, if the company is doing well, it's a credit. If it's not doing well, it will be a debit. Revenues are credit, expenses and dividends, debits. Let's look at making journal entries. And we're looking at three situations. Suppose you bought an automobile and you paid cash of it. What you received, auto, you debit auto 10,000, credit cash 10,000. If you bought it with a note, you debit auto 10,000, you credit note payable 10,000. And if you bought it paying $2,000 down, you debit auto 10,000, you credit cash 2,000, you credit note payable 8,000. So those are standard types of journal entries. At least two accounts, debits always equal the credits when you make journal entries. Can everybody make journal entries?
Yes, sir, I believe so. I'm a little rusty. It's been a while, but I think I can.
Okay, it's been that. So we'll have you make the
Same
first.
goes for me. I'm a little rusty too, but
Y'all a little rusty? Okay.
yeah.
But what happened, we're going to layer managerial accounting on top of this, so that's why we review it. This is the accounting cycle that you're working on that review problem. You analyze each transaction, you make the journal entry, you post it to the ledger, you prepare the trial balance, you make adjusting entries, and a lot of time we just make these entries and then just do the trial balance at this stage. Then we do the financial statements, then we close the accounts. Then that's what's called a post-closing trial balance. We make sure we're in balance after all of these. So this is the accounting cycle that you're doing so that we get this review of financial accounting, in so that, some of you like to say you're rusty, you hadn't done it for a while. Most are quiet. But one of the problems I ran into in teaching out of that managerial accounting book, they did no review. And so they're expecting you to be able to do this, okay? And they wrote problems and everything. So if you didn't have a handle on this, it was very difficult to understand and pass the course. So this is written mainly for the managerial side, starting with a good review So then you could go on into managerial accounting. A little chart here, assets, they can have debits and credits, but the normal balance of an asset is a debit. Contra accounts can have credits and debits, but their normal balance is a credit. Liabilities, normal balance is a credit. Common stock, normal balance is a credit. Retained earnings, credit if it's doing well. Revenues are going to be credit. Expenses and dividends are going to be debit. So that's what the balances should look like. And in Principles 1, we looked at about 20 journal entries. And so with these journal entries, I basically say these are the journal entries that we're making. Journal entry types. We have journal entries where cash comes in and cash is debited. We have journal entries where cash is paid out and cash is credited. And then we have asset transactions other than cash. And then we have some liability transactions other than cash. Then there's a chart of accounts. And as in that course, and if you, as you're working your problem, these are accounts you're using. So you don't create any new accounts. You get an account with a number. There's no such account as asset purchase. You've got to find, if you purchase an asset, was it supplies, insurance, land, you've got to find me an account with a number and put that in your journal entries. So this chart shows you the types of transactions. You identify the transaction. And then when we move to this chart, it shows you what account you're supposed to be using number-wise to make your journal entries. So that's one of the foundational things I did in the in teaching the course, to say, okay, these are journal entries, these are the accounts, to frame it so that I didn't have students who were coming up with all kinds of accounts, and I didn't have students who were making journal entries with one account only. You always got two accounts. Are there any questions at this point?
So you said pretty much always make two journal entries because you always gonna have two accounts, right?
You make one journal entry, and there's
One
always
entry, two accounts.
there's always two accounts.
Okay.
When you make one journal entry, there's always two accounts. Two things are happening. Okay, two things are happening. You're getting something of value, and you're receiving something of value. So only one or two people said they were rusty. So
Is this document in the course content, or is this something you have?
that's the primer. I think maybe, is this in course content right now?
Oh, it's the primer. No, sir, I don't see it. I was just trying to see if I could follow along, but that makes sense.
Is it
Excuse
not
me,
in,
sir, I have a question.
is it not in course content?
No, sir, I didn't see it.
Did anybody see it in course content?
Yes, it's in there.
Oh, somebody saw it in course content.
Yes,
Where
it's
was it?
there.
What is it under?
Probably under what, the
It's
financial
under
framework.
one of them is under managerial accounting, whatever, and then the other one is under the accounting cycle fall 2021.
So it should be there, and So why don't you all make journal entries 1, 2, 3? Let's see. Just make journal entries 1, 2, and 3, and let me see how y'all coming. And how much time is it supposed to take to make a journal entry?
Like 2 minutes?
2 minutes. So let me see who can make these first 3 journal entries. Let's see. Trying to put this up. So here are these. Here's your chart of accounts here. So if I told you to make the, well, make the first journal entry. So that's okay. Make the first journal entry. Not you.
Yeah, Mr. Boyd.
Yes.
Not me?
Yeah, I just want to confirm. So you want us to do this on the new Excel file, or?
Yeah, you can practice on it. That's a good time. That's a good thing to do. Go to the Excel file.
You want anybody to answer it?
Any new student. Well, they said they could make journal entries, so I'm just saying. It's kind of good to know you. It's kind of. So if you started a company and you invested $10,000, what would that journal entry be? I'm gonna have to move this class back to Monday and Wednesday so we can meet on Friday so y'all can catch up. So I'm gonna have to move it back to Monday and Wednesday. That would be Fridays.
Please, because I don't even know what this is anymore.
You know? So you want to meet on Friday?
Mr. Bud,
I don't
Yeah.
have a problem meeting on Friday.
I don't have a problem either.
you're gonna debit cash $10,000 and you credit common stock.
That's correct. So when you start a company, first thing you gotta do is gotta put some money in the bank. Those accounts are cash and common stock. So you'd make an entry, debiting cash and crediting common stock. The account numbers are 100 and 400. And that's a type 1 transaction. That's the first journal entry that you learned how to make. All right, received $40,000 working capital loan. Let's go on that one.
Professor, is that debit cash 40,000 and credit accounts payable?
Not accounts payable. Account payable is when you buy some merchandise. So what else could you credit over here?
Is it accounts receivable?
Oh no.
No.
It's
Probably
notes.
short-term note payable.
It's notes payable.
So an account receivable when you have something coming to you, but you borrowed money, you got to pay. You know, just like those student loans you get cash, then you got to pay it back. So this is an example of a student loan. You don't have anything A receivable is something that's going to come to you later. Okay, what's our third one? Purchase supplies on account. What we're going to do there?
Mm,
Credit,
Wait, Professor, we're doing number 2, right?
We did
number
2,
three.
and we
We did-
said 2 was we debited cash and credited note payable, 40,000.
Number 3, you debit supplies
Debit supplies,
and credit account payable.
credit account payable. Debit supplies, credit account payable. So what we're going to do is we probably will start off the class with the new students just making these journal entries. Okay. So you should have a chart of accounts and you should have your journal entry types. So you may need to make hard copies of these 2 documents, transaction types then this chart of accounts. And then we'll go through quickly and do these 13 journal entries. Because see, we can't even get anywhere else in the accounting cycle if you can't make journal entries. So we'll review this. I'll see what I do it first. I'll probably do it second. I'll let my continuing students say how they do. See how many of them I need to have here on Friday. But, you know, so we're layering principles 2 on top of principles 1. So the big problem in teaching principles 2 is that if you don't have these things down in principles 1, you got to make these journal entries plus some others. So it's very critical that at this point in time that we get this review in and you go to get yourself where you need to be. And we're looking at the total process.